if you're trying to go it alone, this space is now so well established. You're really going to be an army of one facing now an army of, I think, 240 registered MICs. And that's just under the Income Tax Act. There's also mutual fund trusts. There's also GPLP structures. I think that we don't need new logos. We need new products. We need more innovation. We need more government support.
Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal, Andreino, and Ryan MacNeil. Enjoy.
All right, we're here with Benjamin Sammut, founder and principal of Dabble Capital Advisory. Welcome to the show, Ben.
Thanks for having me, guys.
You're going to prepare yourselves, everyone that's listening, that there's going to be a bit of a delay because Ryan and I are sharing an office and a microphone right now. But yeah, try and stick with us, and we appreciate you. Ben's got a lot of interesting stuff to say. He works in a interesting firm I think is really unique, and so I'm excited to hear what he has to tell us about it.
Yeah, Ben, why don't you kick off just a little bit about kind of your background, kind of how you land. We always want to hear how people landed in the mortgage space, and I know you've kind of got a unique background and a unique proposition with Dabble Cap as well. So I'd love to hear about that to kick it off.
Yeah. So I grew up in the mortgage industry. My parents are mortgage brokers. They have been for about the last 35 years or so. So we always joke my first words were amortization schedule. So when I graduated university, I got into brokering as well, started as just deal admin and then eventually fully underwriting and then brokering myself. And I did that for about 6 or 7 years until around 2018, it started to B20 started to take hold. Deals started to become more difficult to complete on the A side, and there were a lot of market shifts. I could just start to notice some of the volatility. And I remember at the time thinking that, mortgage brokers are incredibly talented at what they do, but unless you have a direct demand to upskill yourself, there's a lot of knowledge gaps that can creep in. And if you're, a 20 or 30 year vet, definitely not as applicable. But there I was, 6-7 years in the space. I didn't know why rates would move. I didn't know where lenders got their money from. I'd never seen a Bloomberg terminal. And so I moved over to the capital markets side in 2018. Through a very fortunate series of events, I partnered up with a vet in the capital market space. And we started buying and selling tranches between different MICs. That eventually led to me having to fully understand the MIC business model, get into all the nitty gritty on their operations, to their portfolio management and their sales and underwriting strategy. And ultimately, it turned into me going full-time consulting in the capital market space. So earlier this year, I launched the brand Dabble Capital Advisory so it could more formalize what I do and not just have it as me being a one-man band. It's a continuation of my work, but we're now focusing specifically on how do we get larger institutional investment access for MICs? How do we advocate for the space as a whole rather than each MIC individually pursuing their own goals? And so in essence, we'll go into more detail later, but I wanted to create a one-stop shop so that if you are interested in investing in the mortgage space, you don't have to perform due diligence on 200 plus funds. Come to us and we'll guide you through that. We'll provide all the context. And if there's cross-border issues or what have you, then I've now become enough of a generalist to really know the entire Canadian market.
Interesting. So it sounds like maybe this, when you first had a light bulb moment for Dabble, was when you're buying and selling tranches with I guess we'll say your mentor, your partner at the time. Who were you buying for? Like, who were you doing that on behalf of?
So the concept was initially that we were going to have some mix buying from others. And if you were flush with cash, you could come and buy a tranche. If you were running low on cash, you could sell a tranche to free it up. We basically just wanted to have a lever that you could pull so that it was another thing for liquidity management. It was nowhere near as popular as we thought it was going to be. There was a lot of, I think the biggest lesson wasn't necessarily in the regulatory side or the mechanics. It was more in realizing, okay, this is a very cards close to your chest space. There is a level of distrust. How my underwriting is pristine, but how can I trust your underwriting? And so when we would look at deals that would be priced, they were trying to discount it outrageously, and it was very difficult to get a deal done. But the thinking was that we were just going to encourage MICs to get along a bit more symbiotically, if you will. And this was before CAMLA and everything else. So Admittedly, the industry's just naturally gone there.
It's interesting you say that, Ben, because, Neal and I have interviewed a lot of different MICs, and every single one of them is unique in their own way. They have their own unique way of
Absolutely.
underwriting. They have their own unique territories, types of deals they want to do, first, second mortgages. So I could see that being a challenge. And I've even had it in my past too, where we've been approached by other lenders, and then, we've got a certain way of lending, which is unique because we're in 4 different provinces of Atlantic Canada. And they'd look at it and say, yeah, we like this small pocket of deals that are downtown Halifax, but nothing else fits our bucket, right? So it's just that'd be a tough challenge to overcome, no doubt.
As you're saying this,
Yeah.
I feel like the only way that I can make sense of it, because when I started and Ryan saw me, I was like, why don't these other groups just invest in us? Like, we could administer it. We get the exposure in Atlantic Canada. We provide a great rate of return. We're going to do a better job than they are. Like, they don't have boots on the ground, but I could never really get them over the hump to do it. And now as I'm thinking about it, it's probably more similar to, like, if you run a real estate investment fund and you buy buildings, you're not going to then go invest in another real estate investment fund. Like, you have your own, and you know your market, and you feel that you underwrite the best deals and the best segment of the marketplace. So it doesn't make sense to then go and invest in another one. I think it's kind of a similar situation.
Yeah, 100%. And a lot of it is MICs have their own mandate, which is so deeply personal because it's rooted in deep experience in their territory or in their niche segment of the market. And if you saturate that market and you're now looking for a new frontier, that does happen from time to time. And in that case, partnership can definitely become a thing, but you'll never see a MIC suddenly realize, like, hey, you know what? These guys could put our money out better than we could, because that would be the antithesis of why you started the MIC in the first place, effectively, right?
The MIC of mix.
The MIC of mix, yeah.
Can you kind of walk us through the fundraising part of your business? So how you access funds through, whether it's hedge funds, asset managers, family offices, and then deploy it within the private lending space?
Yeah. So the way that came to be was twofold. First, I would come in for a fixed scope of work project. Again, it could be that working on a portfolio or setting up a sales team for them or something. But my consulting was always come in for this project and do capital raising for us. And so all roads kept leading to capital raising. And I think that the majority of MICs have an established cap raising strategy where they're going out to the investment advisors, high net worth, some family offices. And then that's sort of the space that they play in, simply because of the nature of a MIC vehicle or MFTs or some of the other vehicles you can see stood up. But oftentimes when I was brought in, and I wouldn't say oftentimes, but sometimes I'd be brought in when it was a little bit too late to just have ongoing capital raising, and they would more need capital in a pinch. So they needed to sell a very large tranche of, say, 40 to 50 million, or they were in a massive expansion and they needed several hundred million at a time, or a pretty quick runway. And so I was consistently making calls to larger capital sources like the hedge funds or multifamily offices, asset managers, pensions, life cos. And as I was doing this, it was interesting because I realized that I was bridging a gap that no one really knew existed, because you'd speak to these larger institutional investors, they don't even know what a MIC is. They think that the only way you invest in Canadian mortgages is by buying Canada mortgage bonds. And then vice versa, you'd have MICs who, their reporting and their disclosure documents and their overall solicitation activity is tailored to retail investors and high net worth. So when they suddenly need to disclose to a $20 billion asset manager how these proceeds are going to be moved, it's a very different story. And as far as I know, I was the only one in the space at the time that was starting to explore what this could look like to bridge that gap. And that just naturally turned into the progression of Dabble Cap being a brand where, if you are a larger asset manager, you have a check for, say, 400 or 500 million, there isn't a single MIC in the country that can take that much money immediately without cash drag. So you need someone that can come in and show you how to diversify or create a fund of funds, different syndicated buckets, whatever it may be. And then you go into sort of a next tier of capital markets management and the overall cap flows.
So that's interesting. So your client then becomes one of these large asset managers?
In essence, yes. I would say that similar to a broker where you're having to represent both borrower and lender, I have to represent both MIC and investor. Because at different times in the transaction or the relationship, I'm more representing the interests of one over the other because that's where the due diligence is required. But I more so look at it as a deal is coming up, I'm the I don't want to use the word custodian because that holds weight in this industry. I am the shepherd of that that transaction, if you will.
So just going a little deeper, when you mentioned, say you got an asset manager who wants to put 300, 400 million into Canadian mix, do you then go and kind of contact mix within your network and then try to spread it out amongst them? Is that kind of the goal, or is that how it looks typically in a transaction?
Yeah, I think in the initial phase, I was a bit Pollyannish, and I thought, we'll just have even representation for every single MIC. But at that point, I don't really serve a purpose, and I'm kind of trying to become the Robin Hood of the space. Also, that word also holds weight in investments. But when it came to our first syndicated transaction, I realized that the concerns of these investors are largely, we don't even know what we're looking for. We know we're chasing yield. That's our first priority. We know we want risk-adjusted yield that's going to keep our investors safe. Actually, that's probably the first priority. And then outside of that, they're kind of looking for guidance on, do we look at small cap versus larger cap? Do we look at commercial versus resi? Do we want East Coast or West Coast? And oftentimes those aren't known because this is a new appetite that's emerged. Historically, if you've got investors that are looking at the alternative space, REITs are massive. And then you get into really niche alternatives like music rights or storage facilities or what have you. And the mortgages as investments have always been around, but they've been kind of boring. So when all of a sudden they realize that there's a high yield opportunity or, a more aggressive opportunity in the space, they're a little bit unprepared in knowing how to define their appetite. So I make it our goal to be able to sit and speak with them, figure out exactly what the overall goal is, what the timeline is as well. And then sometimes it can just be a direct relationship with a single lender. Or I would say we typically don't put more than 5 vehicles into this SPV that we would create with them, simply because it can be an IR nightmare and reporting and what have you. So I wish that I could say we just give to everybody, although I don't think that's viable. And candidly, there are some MICs that, let's be honest, I don't think deserve investment. I wouldn't touch them with a 10-foot pole.
So many questions. So first thing, going back to the very start, with the asset managers, are you do you find yourself selling the idea of investing in mix, or are they coming to you typically already set that, okay, we've allocated 100 mil that we want to get in mix, and a few other of our partners are in the same boat, and we're going to put this together as a syndicated pool? Help us, Ben.
Yeah, it really depends. So sometimes, you'll speak to, let's say it's a larger multifamily office and they're already participating in mix. They've got their 2 that are just absolute darlings of their portfolio and they want to get a third. The pressure that's put on them when they need to match that similar performance and reputation, that's where they would call me, because they want to ensure that they're making the right choice there. Other times they'll come to me and say, we've got a fixed income mandate. We know we need to have yields that are over, say, 7.5%. What's the safest looking option that you can get us for that? And then others are purpose-built mortgage investment vehicles that, already have a massive representation in the US or in Europe. There's some of them are now coming from India or the Middle East. And they know that they're familiar with mortgage investment. They just don't know the Canadian space. So I'm then, again, providing historical context on how B20 has reshaped it, more regional context on, where you're going to see bonkers real estate markets versus more stable markets. Basically, they tell me how much they need, and then we're able to go from, what is it, soup to nuts, is the saying?
It's a new one for me.
It must be a Western Canada thing.
Not the soup. So, okay, and then you made a mention of a special vehicle within that. What exactly are you talking about when you say that?
So the vehicle, I mean, the easiest way to invest in a MIC is buy the existing shares.
Yeah.
But MICs already have concentration limits, so you can't exceed 25%. And if you're a MIC under, say, 70 million, that's really difficult to get a significant investment impact on a larger asset manager or a larger investor. The other thing is, sometimes they don't necessarily want to come in just for share capital. Other times they might want to structure it as a debt vehicle, or they want to create a special share class, or other contingencies, because they're collating or syndicating multiple investors on their side as well. So depending on how many participants and parties there are, we can either stand the vehicle up and create the framework ourselves, or more often we'll actually help them stand it up, so that way all of the reporting and regulatory burden and everything stays with them, so that way they're familiar with it, and we're just helping them build that in-house. And it allows us to maintain our position more as advocates rather than direct soliciting salespeople, because you as a receiving MIC will have enough of the licensing and the infrastructure to do that. They as the investor will have the same. There's no need for us to create another vehicle that's going to clip another fee. Eventually you start to get sort of fee fatigue, if that makes sense.
Sure. So Benjamin, walk us through how Dabble Cap gets paid here. So are you paid, certain basis points on the total transaction, or is it a fixed fee, or a combination of both?
Yeah, so if it is a fixed scope of work, we still do have the consulting arm. So simple, straight hourly fee. And then for the capital side, as and when capital is introduced, I mean, that can be any number of ways. It can be, again, the direct investment in the fund. It can be a debt vehicle created. It might even be buying or selling tranches from time to time. So we have a set fee that we would typically target. Non-cost prohibitive. We don't want to move too much of the mechanics of the overall investment, but it depends on the individual vehicles. So we'll move that to not affect margin too much. Usually you're speaking anywhere from sort of 10 to 40 beeps, give or take.
That's reasonable.
Yeah.
I hope so.
Better than our EMDs.
Better than some of the EMDs out there. So interesting. How has it been so far? So you've been having good uptake then on the Dabble Cap side? Like, have you been getting the reach that you wanted with it?
Yeah, so when I launched the new brand, I was actually surprised. I had more interest coming from MICs than I had expected. I mean, I've always maintained a pretty good relationship with almost all the MICs across the country. I go to the CAMLA and ONMICA events and so on. And I realized it was very easy to have conversations with MICs, but to the point where I started to get inbound demand that was difficult for me to maintain with my existing pool of investors. So I really had to up the other side on the investment side. So we have some pretty reliable investors that we will either place or keep apprised of what's going on a regular basis, but we really had to up our outreach. So, we're on the phone with 30 to maybe 50 investors every day, looking in different markets that are more friendly from a tax perspective for investment into Canada. And then now that's ironically created more of a tax awareness that we need to worry about, like who has better tax treaties and where is that money going to come from? Is it better to set up something like a Cayman trust or just participate directly or create something on the ground? Like it's just created a new level of complexity that we didn't really anticipate at first, but it's now becoming more relevant. So to answer your question, yes, the demand has been really interesting. It's been really great, but Canada as a market still has a long way to go before we're relevant on the global scale the way anything in the US would be, right?
Yeah, something that I think we've seen as well, like the accounting and tax management side of it seems to be such an important, well, not seems to be, it is such an important part in this kind of an investment, because it can consume a big part of the return if it's not dealt with properly. How are you being targeted in making your call outs if you're calling like outside of Canada? Like, I feel like I feel like it's difficult within Canada to make good targeted effective calls. To then make outreach outside of this country, I feel like would be a really difficult task.
Yeah, I mean, if I'm like in my time zone right now, I'm like 12 hours behind India.
Yeah.
So if I'm speaking to Indian family offices, I'm normally starting my outreach, and then within 3 to 4 days, we're going back and forth. It feels like the old messages on a ship back in the 1800s. So that can be a bit difficult, but a lot of the time, if you think of even just the Eastern time zone, the 9 to 5 is pretty much the same from Toronto down through New York, down through Boston, and then even into like Latin America. So it doesn't really make a difference where I'm calling you. It more so makes a difference on what your investment cycles look like. So we're largely focused in the US. Again, lots of European interest is coming in as well, but an investor is an investor. And sometimes you'll find niche success in a really eager family office from Chile, or I'll get an inbound request from someone from Jordan or Saudi or something. Now, do they always come to fruition? No, but I find that as long as you're putting yourself out there on a consistent basis and establishing yourself as a fund agnostic industry expert, inbound is pretty active.
On that outbound, again, I'm just curious because I get a lot of phone calls from investment firms that were trying to pitch me on different products or whatever it is, and I typically don't give them the time of day. Like, how are you kind of breaking that ice and actually getting in there and having the conversation with them? Because again, I feel like it's just personally, I immediately almost shut them down. It's someone calling from another wherever part of the world, and I'm just like, I honestly don't believe it. Almost, I think maybe there's been so many scams and frauds and everything. I don't believe half the stuff.
100%.
And then it's just tough. True, like I find out most of it is it's much easier when it's done in person or you've had a introduction made.
Yep.
So I'm just curious how that looks.
Are you a private mortgage lender in Ontario looking for trusted legal support? Meet Grecky Carter Professional Corporation, a boutique real estate law firm in Midtown Toronto with deep expertise in private lending and mortgage enforcement. Grecky Carter closes hundreds of private mortgage deals every year, and when recovery becomes necessary, they handle both contested and uncontested enforcement with precision, from forbearance agreements to power of sale and cost recovery strategies. For lenders who demand clarity, efficiency, and results, Grecky Carter has you covered. Visit gclaw.ca to learn more and safeguard your private lending investments.
Yeah, I mean, obviously, like warmer leads are going to be the best always. Mm-hmm. But I find that investors with capital want to invest. They want to know about investment vehicles. And so if you approach them in the right way, it's not intrusive to say, hey, would you be interested in this vehicle? Now, I think that one of the assets that I have as being not my own fund is that I don't go out and say, listen, you need to put your money in my vehicle or bust. I can say, listen, we have almost 300 different vehicles that you can put your money into. Let me help you create something that's to your need. And all I had to do to even have that conversation was just establish, hey, do you have a fixed income strategy, or are you interested in residential, consumer debt? And oftentimes it's a more of a nurtured conversation going in. And to your point, though, about there being a lot of crypto scams and other investment schemes that just seem way too good to be true. Admittedly, there are some MIC investments that yield over 10 or 11%. And that can be pretty scary. But if you're speaking to investors that are used to those kinds of returns, or if you're speaking to people who would target something like that and be more trepidatious, I find thought leadership is just the best way. Mm-hmm. And with this podcast, you guys are already establishing yourselves as major experts in the space. But, the more you give away for free and the more you establish your legitimacy and frankly have a bit of a laissez-faire attitude toward it. Like, listen, if you're not looking to invest in this, I'm not looking to force you to invest in this. But if you do have an interest, let's learn together. Let's have a conversation and figure out what you want to achieve and where I can contribute.
Yeah. Well,
it's as easy as that.
Yeah, very well said. So you mentioned previously putting yourself out there, and that's how I saw your name initially, was through LinkedIn. And I know you and I connected recently, but you were also featured in a Canadian Mortgage Professionals article recently, and you kind of voiced that you saw the mixed space as saturated and you were anticipating a slowdown of new entrants coming in the coming years. So can you kind of speak to your thinking on this?
Yeah, there's a few elements to that. I think first is I have brokered, and as a mortgage broker at the time, I remember I knew of 2 MICs. And when a third one would enter, I thought, wow, this is just incredible. I now have another option to bring my clients to. But once the 5th and then the 10th and the 20th started to come through, I was like, you guys are all the same. And you're not. you genuinely are not all the same. But to your broker network, which is your chief origination source, eventually there's only so many logos they're going to remember. And at the end of the day, they're going to prefer one over the other, and they're just going to submit deals there. So as a new entrant trying to challenge the incumbents, I think it's a real uphill battle to try to create a new logo that's going to make waves. But at the same time, though, I think that the amount of money that's already in the space and the amount of awareness that brokers have of the mixed space and a lot of other macro factors as well, like, the credit curve is moving, people are going to be dropping down into privates more often. I think that there's just so much more opportunity in amalgamation and, M&A and joint cooperatives or sort of cohorts, if you will, The mix are also, just since I started doing this in 2018, they are also starting to play nice with each other a lot more often. And you're seeing these more strategic relationships, either cross country or cross asset class, where if you're trying to go it alone, this space is now so well established. You're really going to be an army of one facing now an army of, I think, 240 registered mix, and that's just under the Income Tax Act. There's also mutual fund trust. There's also GPLP structures. Um, I think that we don't need new logos. We need new products. We need more innovation. We need more government support.
We have a pretty good logo, though.
Yeah.
Very good.
You guys do have a good logo, and you're carving a beautiful niche for yourselves. And there's still opportunity. Don't get me wrong. We can still see new mix coming in, just nowhere near what they would have been in the 90s and the 2000s.
So just on the other side of that, Ben, so we haven't seen it. You don't see a ton of acquisitions within the mix space either. I know recently we just spoke to Alta West very recently as West, and they just acquired Premier Mortgage out in Western Canada. I was part of another transaction with Graysbrook Capital out here selling to a credit union in Atlantic Canada, and we've seen that happen a couple times. But for the most part, you don't see many major acquisitions in the space. So do you feel that's going to evolve here in the coming years?
I think so. I think the issue that we've seen so far, and I've participated on a few interested parties in M&A, both on the sell side and the buy side. I think the biggest issue that we have currently is that a lot of mix are still, long-standing reputation, founder-led, and this is their family legacy. So there is a lot of ego in the space, which isn't necessarily a bad thing. But you are asking someone to let go of their baby. And so they typically want 9 or 10 times earnings on a sale. And like you're starting to get into fintech valuations. It just, that doesn't necessarily make sense. The average offer that I've seen from a buyer has been usually below 2%, or sorry, 2 times earnings. Sometimes as high as 3.5 to 4, but that's still a massive gap between who wants to sell and who wants to buy. So just the fundamentals of that have been why it doesn't happen that often. And especially within the space, if you have one MIC trying to acquire another MIC, that's where you have that, do we play nice kind of dynamic starts to come in as well. Alta West, I have nothing but incredible things to say about them, because they not only have a great reputation amongst their brokers and their investors, but as a business running, a well-oiled machine, they were able to draw the eye of private equity. So you're not just talking about one MIC acquiring another MIC, you're talking about a completely different industry coming in and wanting some of your asset class, and you're the star of the show. So I think that that's going to start to happen more. You're going to have maybe not VC networks, but definitely private equity or purpose-built asset managers that want to acquire in the space that will start to come in more strategically. But again, it's going to be piecemeal because there aren't that many companies. It's not like you're buying, a lawn care company or a plumbing company where there's thousands. There are only so many private lenders in Canada. So it will be few and far between, more strategic, but it'll be more impactful when it happens.
Interesting. Do you think when these PE firms try to come in and buy it, I think they'll end up degrading the brands? Like, because your point, a lot of them seem to have a point man at the helm that really drives the whole MIC at the end of the day. Not necessarily actually driving the staff, but they're behind the brand. They were the original, had broker partner relationships. They had the original investor relationships. Like, they really are what it is. Do you think when PE comes in and starts buying some of these out, that gets beat up?
Well, I think private equity kind of has a history of, stripping a company for parts.
Yeah.
In the mortgage space, though, I mean, you really only have a few parts. You've got your portfolio of mortgage coupons, you've got your manager, which is getting a lot of the revenue, and then potentially your servicer. And I think if you are an investor that's interested in acquiring a full operation like that, most of the time the operation only works if you've got everything. Like, you can't just sell off these assets here. You may see a bit of a different business model where they switch from being portfolio management to more originate-to-sell, or they're consistently selling tranches out. But I think that would only work if the underlying supply of mortgages, so your broker network, your borrower base, if that's consistent. So I don't think that it's as prone to not corruption, but sort of bastardization of the business model. I don't think that's going to happen as much in an acquisition of a MIC. And the other reason why I think it would be a good thing is the founders. I cannot stress enough how much respect I have for more established founders in the space. But if you started a MIC in your garage back in the late 90s or the 2000s, mortgage brokers at the time only had, I think it was like a 15% share of originations. Now they're over 50%. And borrowers at the time would go to a MIC because we called them lollers, right? Lenders of last resort, because there was such a robust prime space. Whereas now, post 2008 and post B20, this is now becoming sort of what home trust looked like maybe 20 years ago. So your borrower base has changed, your broker base has changed, and having a new leadership come in and be more data driven, be more strategic with sort of a bigger picture thinking, I don't think that's necessarily a bad thing. And oftentimes these founders, they're not getting acquired when the founder's on their deathbed. They're usually getting acquired over a longer progression plan or succession plan, where the founders usually stay on for 3 to 5 years anyways, and they'll inform a lot of that vision.
Have you had any of the firms that you're working with that are looking to place money ever consider that, instead of being like, well, instead of us maybe buying into one of these firms, why don't we just buy an entire firm?
They have. Investors are pretty niche though. So if you're a fixed income strategy like a pension, you don't have any room in your portfolio to all of a sudden acquire a MIC manager. It doesn't really make sense. If you're more opportunistic, like a family office where you can ebb and flow with investment cycles and different asset classes sometimes, but usually the caliber of MIC that they're looking for is going to be kind of 300 million AUM and above, and they just don't have the money to buy that. So the ones that are available to them don't really fit their mandates. They kind of stay in their lane in that sense.
Interesting.
Makes sense.
Yeah, makes sense.
So you're on the front lines right now. So how do you feel capital raising in the private lending space is going to evolve in the next couple of years?
Well, I think because everybody has gone after the investment advisor network and high net worth, that space is fairly saturated. So odds are you're probably never going to call another investor again that hasn't heard from another MIC already, which is why I think that institutional investment is kind of the vanguard of the next wave of investment coming in. More strategic, larger checks, more structured, better reporting, and so on. And I think that the other thing for where capital raising is going to go is, right now the MIC model makes the most sense as clipping management fees off of a performing portfolio, but that has its limitations to scalability, because if you want to become a $10 billion MIC, you need to hold $10 billion. Whereas if you look at something like a monoline in the prime space, if you want to be a $10 billion monoline, you really only need a $100 million line of credit that you're consistently revolving and selling off into the market. So I think that we're going to see a strategy over the coming years where there's more infrastructure to consistently buy product, and we'll deviate from a MIC having to manage everything to a MIC being what they always are, very strong origination. And then the actual owners of that paper can be, again, larger investors like pension funds and hedge funds and so on. So think more like the monolines, like even something like a First National or a Strive, they don't hold any assets on book. They sell everything. That's their model. And I think that MICs that are moving towards that will be at the forefront of the next wave, in which case capital raising, it doesn't become irrelevant, but it very much changes the name of the game.
Yeah.
How do you think the real estate market impacts people's desire to invest in MICs? Like if we start seeing, we've seen a declining market in most of Canada now for the last 12 months. Do you think that's changed people's desire to get exposure to the mortgage market?
Yeah, it's had some impacts. Like you look at the market chaos of 2022-23, a lot of people were losing their heads either as borrowers that were buying at record highs, or MICs that were putting money out at record lows. And I think that has largely cleaned itself up. But there were some MICs that either flew too close to the sun, or they might have had a multiple asset category strategy where they were both lending and doing real estate equity, and they've started to gate their funds. I think that gives a bit of a reputational risk. But if you have someone who's at least interested enough in having a conversation to a MIC and learning the fundamentals and how they how they manage workarounds, how they have exits, and what the churn is of the business. I think there's still a lot of interest because they recognize that the real estate market in Canada is a unique beast. It's very there's a lot of government hands in it, so you're not dealing with a normal open free market, if you will. Canadians using their home as their investment, that's a unique attribute of Canadian borrowers. So I think that it's very easy to say, yeah, there was a bit of a downturn coming from the market mania of 2022-23. But at the same time, though, you're dealing with an investment category that has 1 year paper and consistent churn. You're dealing with LTVs that are sub 70%. So no one's expecting a 30% market crash overnight. There's a lot of security and safety that's baked into how MICs lend. And usually it's just a quick, oh, you thought that, it's not actually that. And then you just continue your conversation.
Interesting. Yeah, that makes sense. Cool. One other question I had was just, if you're saying that like MICs are starting to go towards selling off the papers, I guess then they're doing like longer amortizations and more secure terms then as well in that process, because selling 1 year paper probably is not extremely desirable.
I mean, if you're keeping that paper, it is pretty desirable.
Yes.
And the nature of the MIC business model is, 1 year churn, and then you might get some fees on renewals. But I think that if you look at the MIC in a category where it is on the credit curve, they're no longer those lollers, right? They're now sort of just below the B- lending. A lot of these are encroaching on home trust territory or community trust territory. And when you have borrowers that are always going to be in that part of the credit curve, because B20 just keeps shrinking the credit bucket of the banks, I think that just organically you're going to see demand from the borrowers that are looking for more than 1 year paper. A lot of MICs are now putting out 2 and 3 year paper. To get to 5 is a little bit excessive. To look at something like the States where it's 25 and 30 year mortgages, I don't think that's ever going to happen. But just because of organic demand, we'll see more of that. I don't think MICs are at a stage yet where they're putting loans on the books considering how marketable they will be to sell off later. I think most MICs are still intending to keep that paper. But they are seeing more interest in buying tranches, and those tranches are now cleaner from a reporting perspective, from a credit adjudication perspective. The terms are more so just going to be driven by the borrower, I think.
In private lending, time is everything. The faster you move, the faster deals close. At Mortgage Automator, we build a platform that transforms how credit unions and enterprise lenders originate, service, and scale their business. No spreadsheets, no chaos. Just precision, automation, and control. From loan origination to servicing and investor management, every step is seamless so you can focus on what matters most. Growing your portfolio and customer base, not managing it. From AI to compliance and everything in between, Mortgage Automator is trusted by hundreds of private lenders across North America and is the highest rated platform on G2 and Capterra. Mortgage Automator, powering the future of private lending.
Makes sense. Very cool. A couple more before we wrap up here. Just wanted to touch on, you mentioned it off the hop, but you grew up in the broker space with your parents being in the space and yourself before starting Dabble Cap. So can you kind of talk about how that's aided you on your new journey here?
Yeah, I mean, it's really funny to me, some of the MICs that I've spoken to, who they create a massive sales strategy and they don't actually know what brokers want. So a lot of the fixed scope of work projects that I would come into would be, how do you create a broker origination strategy that actually speaks to the needs of a broker? And sometimes it's all of the glitz and glam, like rewards trips and points and insiders clubs and so on. And other times it's as simple as like, just pick up the phone, tell us what you lend on and lend on it. You put yourself in a position so that you're not going to run out of money mid-year and then have to turn off the taps. There's not that much that brokers are expecting of MICs that is unreasonable. It's just there's a bit of a disconnect there, because typically in this space, I mean, you guys probably see it, a lot of mortgage brokers see it, very few people cross the floor. You're either always a broker or you're always a lender, and there aren't that many folks that have done both. It's kind of like in the commercial versus resi side. You very rarely are a master of both sides. So being a broker in the past and still having such a large broker network from me doing that, I am the boots on the ground. I get to hear what's going on. I get to hear complaints about certain lenders that I can tell definitively they run a beautiful shop on the inside, but brokers don't like dealing with them because their customer support doesn't work very well. I think it does give a unique edge.
Sorry, I'm fully in this like idea of selling tranches. I'm like, holy god, there's so much. Capital markets are crazy. It's again, just having entered into it, it's all new to me. So what you're saying, a lot of it is extremely interesting.
It's only just getting started in the mix space too. It feels like.
Yeah,
100%. I think there's a new age in the mix space, and yeah, I'll save my tinfoil hat for later.
Oh no! I want to hear it.
Neal loves a tinfoil hat.
I love a tinfoil hat. Give me a little tinfoil. Come on.
So I think that going back to my experience as a broker, and even as a broker kid, when I was a kid growing up, this was pre-2008. We would be on these massive rewards trips, and I as a kid would go on cruises. My parents and other brokers that we knew that were family friends, they were flying to Monaco and they were getting the gold watch and all this stuff. And then when 2008 hit, the entire market dried up. Everything got super safe. And when I started brokering, I remember my first deal being submitted thinking like, oh, they're going to fly me out in a helicopter now. And I had CMHC come and take me for lunch and explicitly say, the sandwich can't be more than $14. And I was like, this sucks. Where are the glory days? Right?
Changed.
And yeah, it's changed. And I think that the reason it's changed, for obvious reasons with everything in 2008, but I think a lot of it has just been that there's so much concentration of government exposure in the Canadian mortgage market. And the mix have always had a unique edge in being able to, pivot as and when they see fit. They have discretion over who they lend to, how they lend, how aggressive they want to be. And their investors have the ability as well to say, we want you to take on more risk or less risk. And I think that the only limitation in the mixed space has been that it's relatively small in terms of capital injection. You're talking 2.5 trillion on one side versus like 20 billion on the other. And so my tinfoil hat is that we're sitting on the precipice of mix becoming today what a home trust or an equitable or community trust were 15 or 20 years ago. I think that the Canadian consumer market is slowly moving down credit curve, not in a bad way, just because the banks are tightening. I think that more capital is being invested in the space. And I think that, I don't think anyone needs to have me racing with the F1 Monaco team, but I think we do still think there is still an opportunity for successes to be made and for people to actually win collectively as an industry rather than just sit in this overly regulated, burdensome, like red tape nightmare. Because at the end of the day, Canadians pay their mortgages. The borrowers shouldn't have to blow their heads. We're getting into a market stability very soon. I think there's a heyday coming for the mixed space where people are actually going to see industry-wide success.
That's exciting. Do you think that that is genuinely, that is super exciting, but it's like, do you think so you're thinking it's going to be more on the consumer side than, let's say, on the commercial growth side?
In terms of commercial lending?
Yeah. Like, do you think commercial lending is going to continue always, like, that's always just going to require the private space to operate? But do you think there's a lot of opportunity on the consumer side?
I think that opportunity is absolutely massive on the consumer side. I think the commercial side is going to be a bit different just because it's always been a more advanced structure, right? Like commercial brokers know what mezzanine financing is. Residential brokers don't. Most residential brokerages don't syndicate, whereas the majority of real estate development is syndicated just by nature of how it's built. And that makes perfect sense. It's a safer way to diversify risk across your investors. It's an easier way to get access to capital with a different capital stack. So in the commercial space, I think it's well enough established that it's probably not going to change too much in terms of a model. In the global sense of what's happening with commercial mortgage-backed securities or boots on the ground, or rather shovels in the ground, I can't really pontificate on that. I don't have enough exposure, but I think that there's the population in Canada has absolutely exploded. Not every Canadian is building an apartment complex. Every Canadian is renting or buying a home. I think homes are where that market is at in Canada.
Mm-hmm.
And there will be pockets of incredible wins in the commercial and the development space. I can't pretend to know exactly where they are or who they're with yet.
Yeah, makes sense.
Can we go one more before the bonus there, Neal, as we wrap up?
Yeah, I will. I'll ask our final question. And there's lots of exciting news coming in the Canadian mortgage space. But what's one thing that you'd like to change in the Canadian mortgage space?
I love this question. I want robust subprime mortgage-backed securitization. I think that where so much of the prime space has the infrastructure to securitize and sell off into global markets, which is a good thing, I think that the subprime or the non-prime space deserves the same opportunity.
Mm-hmm.
And the reason why we don't have it yet is because the government is highly involved in the prime space, even by giving a guarantee. So they're biased in terms of how much risk they're going to allow to be taken on. Whereas in the private space, let the market determine what's going to happen, but put the rails and infrastructure in place to allow that to happen. So yeah, my goal would be that we see a non-prime mortgage-backed securities market that just takes off.
Cool.
Does the government have to be a part of that for the securitization to take place, or could there be a private securitization done?
Normal securities legislation would be included, but otherwise the government doesn't need to come in with a guarantee. They don't have to regulate lenders the way that they do the banks through OSFI. I'm not an anarchist or by definition a free market capitalist necessarily, but I think that if there are investors that want to take on a risk and you are able to amalgamate those investors into a large securitization network, you should be allowed to do that. So long as there's proper disclosures, everyone's informed, everyone has the appropriate size to afford some risk. I don't think the government needs to be involved.
Got it. Interesting.
Which is so anti-Canadian. The government's involved in everything now.
Yeah, 100%. All right, bonus question time, Ben. So your categories to choose from are sports or food. Do you have a preference?
Ooh, I should probably go food.
Okay, love it. Okay, so Raimi, you grew up in Ontario, is that right? You grew up in GTA?
I did.
Yeah, and you've since moved to Calgary recently.
That's right.
Okay, let's talk Calgary then, because I'd say we've had fewer guests on from the West Coast. So, want to talk about what's your favorite spot you've been to Calgary? What are the hot spots to go to? Maybe your favorite restaurant or favorite type of food in the Calgary area.
Oh man, okay. So the thing I've noticed since moving to Calgary is that it is a cheaper province, but food is actually about the same price as Toronto, if not a bit more expensive here. But Calgarians don't put up with bad food. So everywhere in Calgary is good food. It doesn't matter if you're going for Indian takeaway or tacos or sushi, like you get good food in Calgary. Recently though, some people may scoff at this. I had there's a place downtown called Pizza Face, and I had a dill-pickle pizza from them, and it was like one of the best things I've ever had in my entire life. Okay. So I would say hands down, if you're ever in Calgary, get a dill-pickle pizza. It's so worth it.
Amazing.
I think I've had that, and I'm going to second you on that.
Yeah. Oh man, it's not for everyone, but I adored it.
we used to exclusively ask people what their favorite pizza spot was, so I'm kind of glad that you circled back to pizza on your favorite spot there. So we'll add that one to the list for when we're out there next.
Oh, good to know. Yeah, I invite you guys out for sure.
Amazing. Benjamin, that was awesome, man. Really appreciate your insight here. Really cool perspective from the seat you're sitting in within the mortgage space. So really appreciate your time, and hopefully we'll have you on again soon.
Thank you so much, guys.
Thanks, Ben.
Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan MacNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.